Hi everyone, hello, howdy. So this video will be on monetary policy and money. So let's get to it. Now, we said government policy to influence the economy can be divided into two: monetary policy and fiscal policy. We said monetary policy involves interest rates and money supply, while fiscal policy involves tax and spending. Okay, how does the government use monetary policy and fiscal policy, you might ask? Let's start with monetary policy. Okay, so with monetary policy, um, the government might increase interest rates to slow down the economy, because when interest rates are high, people don't want to borrow from the banks, and people put their money in the banks to take advantage of interest rates. So that would slow down the level of economic activity. Money supply as well. The government could decide to print less notes, and that would slow down the economy as well. Um, with fiscal policy, that involves taxation and spending. So if the government wants to restrict the level of economic activity, it can increase taxation and they can reduce spending, and vice versa. Okay, now we have another video on fiscal policy, so this video will be on monetary policy. Now, like I said, monetary policy revolves around how the government controls the level of economic activity by controlling interest rates and money supply. If we're looking for a formal definition, what you'll find in most textbooks, you find this: monetary policy consists of the actions of a regulatory body that determines the money supply and interest rates. Monetary policy is maintained through actions such as modifying the interest rates, buying or selling government bonds, and changing the amount of money banks are required to keep in the vault. This is the concept of bank reserves. Okay, right, let's start from the top. Monetary policy consists of the actions of a regulatory body. Now, because the government needs professionals to do this job, it needs a regulatory body, usually the central bank in most nations, or the Federal Reserve in the US. In the UK, the Bank of England handles this function. We have the Monetary Policy Committee of the Bank of England. Okay, they determine money supply and interest rates. Okay, now we said monetary policy is maintained through actions such as modifying the interest rates. So when interest rates are high, you slow down the economy. Interest rates are low, you speed up the economy. Okay, buying or selling government bonds. So the government, if it wants to sort of mop up money in the economy, so they want to take money from the economy, reduce the level of economic activities, they could sell government bonds. So individuals, banks, financial institutions will buy government bonds and give money in exchange. So that will mop up money from the economy. If the government wants to speed up the economy, the government would buy its bonds back. So give individuals cash and buy those instruments back. Or we could change the amount of money banks are required to keep in the vault. So your reserve ratio. Say, for instance, the government says, hey, you have to keep 10% of all the income or all the monies that people bring to your bank, okay? Or the government says 20% is what you must keep. 20% is higher than 10%. So you can see that with 20%, there's less money for the banks to give out because they have to keep 20% of every money you give them in their vaults. So this is how monetary policy is done. And there are various financial institutions in the UK, and we will talk about them now. So in order to make sure monetary policy is done properly, you need a central bank. Here in the UK, we have the Bank of England. It was established in 1694 and it's the UK central bank. What do we mean by this? It's the government's bank, so it does all the banking activities for the government. is also a banker to commercial banks. So all your other commercial banks, Lloyds, TSB, NatWest, Royal Bank of Scotland, Santander, you name it, they all have to work with the Bank of England. The Bank of England also holds gold and other foreign exchange reserves used to influence the foreign exchange, so our gold and all that. They control the issue of notes and coins. They promote and maintain monetary and financial stability to contribute to a healthy economy. So, monetary policy, advice, that's what they do. Then Threadneedle Street in London, you can go check them out. That's what the place looks like. Now, when we talk about central banking, what do we mean? A central bank is a public authority that provides banking services to governments and commercial banks, supervises and regulates financial institutions and markets, and conducts monetary policy, like we've said. Monetary policy is the attempt to control the inflation and moderate the business cycle and provide the foundation for sustained economic growth by influencing the quantity of money, interest rates, and the exchange rates. Okay. Central bank provides banking services to the government and commercial banks, similar to that the commercial banks provides to individuals and firms. So remember, when you walk into your Lloyds TSB or you walk into any other bank on your high street, it's no longer Lloyds TSB, it's Lloyds Bank and there's this TSB, okay? Or you walk into NatWest, for instance, or you walk into Nationwide, right? The same way Nationwide or NatWest provides services to you, the central bank provides services to all the other commercial banks and the government, and they also conduct monetary policy. Okay, so very important. All right, more functions of the Bank of England. We already know it's the UK central bank, but it's also the lender of last resort. So if all banks run out of money, they can borrow money from the Bank of England. That's why we call it the lender of last resort, right? It sets the reserve ratio of banks. So that's the minimum percentage of deposits that banks are required to hold. It's 3% now in the UK. It might go up to 4.95% in 2019. Okay, so that means that, for instance, if you take £100 into your bank, the bank must keep £3 in their reserves, and they can give out £97. Okay, you can loan this out, you could give it out to somebody else who wants it. Okay, but they have to have £3 for every £100 right now. And base rate as well. So the central bank sets the base rate. So this is the rate at which the Bank of England will lend to other financial institutions, which will in turn influence the rate that other financial institutions will lend out. Okay, if the Bank of England lends at a base rate of, say, 10%, then other banks wouldn't want to lend out at any rate lower than 10% because then they would make a loss. Okay, so these are other functions of the Bank of England. All right, now let's look at other financial institutions in the UK. How about other commercial banks, like retail banks? These were established under the 1979 and 1987 Banking Acts, constituting of a series of financial institutions supervised by the Bank of England. For example, you have your Barclays Bank, your Lloyds, and NatWest. And what do? They provide banking facilities for individuals and businesses, current accounts and loans. Okay, me and you, right? So that's what they do. They provide banking services for individuals and businesses, people like you and me. How about merchant banks? These are specialized in receiving large deposits from and lending to businesses. They also raise finance. Okay, Barron's Bank, George Peabody and Co., AIB Capital. So they specialize in large deposits as opposed to, the small money that people like you and me have. How about building societies? These are owned by the people who save with them, like Nationwide. Although some have become owned by shareholders in the 1990s, like Halifax, Abbey National. Okay, as opposed to other banks, they are owned by the people who save with them. About finance houses. These specialize in lending to individuals, okay? So they lend depending on your need. Finance House Limited, a self-build portal, Imperial Blue. Some of them lend, for instance, if you're going to build your own house as opposed to getting a mortgage, okay? But these specialize in lending, and that's why we call them finance houses, all right? How about discount houses? Discount houses specialize in short-term lending to the government, okay? So they usually borrow money on short-term notice and lend them out, okay? So the government needs money quickly, you go to a discount house. For instance, Alexander's Discount PLC, Carter Island Limited, Clive Discount Company, right? So it's short-term lending. Right, now this might be important to you as an individual, right? Because we all take money from the bank at some point. Okay, so let's start with what factors determine how much interest you receive when you put your money in the bank. So when you put your money in the bank and you're expecting some interest, what factors determine how much interest you will receive? First, how long you leave your money in the bank. So talking about fixed deposits, for instance, the longer you leave it in there, the more interest you should get. The amount you put in the bank, okay, so talk to your banker as well for fixed deposits, or you could have some interest bearing accounts. The more you put in, the more interest you should get. And of course, the prevailing interest rate in the economy. But of course, you can negotiate this with your bank. So it's good if you put in money, have your banker, have your account officer, and talk to him or her about this. What factors determine how much interest financial institutions charge you for borrowing? So you need some money from the bank, you need to take a loan, you need to borrow some money, all right? So what factors will determine how much interest you will be charged? First, how much you're borrowing. Okay, the greater the risk, of course, the higher the interest rate, your track record. Okay, so this is where they do a credit history, credit check. If you have a track record of disappointing, then it might be harder. Okay, in other places like the US, it's a bit more flexible, but in the UK, it's harder if you have a bad track record. For how long do you want it? So the longer you want it, the higher interest should be. What assets do you have as security? Collateral. Okay, if you have collateral, then you should be able to get your loan easier. Okay, now the question is, do banks provide collateral when they're taking your money? Not really, or the government is your collateral. But when you're taking money from them, you need a collateral. And then interest rates, once again, the prevailing interest rate in the economy. All these will determine how much interest financial institutions will charge you for borrowing. All right, now let's talk about a very important concept, okay? Money. Money is very important for all our lives, okay? Money, some say, makes the world go round. I don't believe those people. I think the gravitational pull of the sun makes the world go round, okay? But money is important. We all need it in our lives, right? Now, for something to be called money, there are particular properties or functions that it must have. So the properties and functions of money include: one, a medium of exchange. So it has to be something various parties accept as payments, as opposed to a barter economy where double coincidence of wants is needed. So think about a barter economy where I have to trade you something for something else. Okay, say I'm a dentist, right? And I want to buy, say, a banana. Okay, right? I need to find a banana farmer who wants some teeth services. Okay, right? Without that, then there's trouble. So we need to have the double coincidence of wants, right? But money solves that problem. Everyone will accept money. So all I need to do is open my dentistry shop, make some money, and then pay for whatever service I want. Okay? And you can do this, you can use this concept around for any other item. Okay? I make biros, right? Or I sell goats, or I make clothing, right? As opposed to finding someone who has what I want and who wants what I have. All I have to do is sell my item for money. Okay, so it's used as a medium of exchange. That's the first characteristic, the property, function of money. Second one is it's a store of value. So users are confident others will accept it in future as a means of payment. So if I make some money now and I don't want to spend it, I can put it in a bank, and in the future I can use it to pay for goods and services. Okay, think about if you pay me in yams, for instance. Okay, it might be hard to keep those yams, they might go rotten, right? Also, money is used as a unit of account, so it's used as a measure of value. £1, £2, £10. Okay, so £1 is less than £2, less than £10, right? So the more expensive something usually is, the more valuable it is. A yacht, for instance, or an airplane, as opposed to a laptop. Okay, so we can use it also as a unit of account. Right. So why do people hold money? Let's look at what influences the demand for money. The motives for holding money include: one, your transaction motive. So daily living, paying your bills, getting the bus, buying a drink. Okay, you need money for daily living, for daily transactions, and that's your first motivation for holding money, your transaction motive. Second motive is your precautionary motive, just in case. Who knows what will happen? I might be walking and I might hit someone selling some eggs and then have to pay for the eggs, just in case something happens. So I hold some money. Final reason for holding money is a speculative motive. So you're holding whilst waiting to invest in other assets. So you don't know what's going to happen. Let me hold some money, and then maybe an opportunity might arise and I will do something profitable. Okay? Now, adding up all these motives for money, right? Adding all three of them up is what we call your liquidity preference. The reason for holding money, for holding liquid cash, as opposed to putting it somewhere else. Okay? Now, the market for money depends on the demand and supply of money, right? So demand, people who want the money, supply, the government who should supply its money. So there will be an equilibrium, like we've studied in previous lectures. There will be a place where demand will be equal to supply. In this case, the price you pay when you save or you borrow money is interest. So the price of money is interest. And your final class activity is: why is the money demand curve downward sloping? Okay, why is the money demand curve downward sloping? I'll say it again. Why is the money demand curve downward sloping? Find this out and bring it to class. All right, so that's it. Thank you, ladies and gentlemen. Be good to yourselves, be good to your families, be good to each other, and I'll see you later.